Hey everyone! In this video, we'll break down who really moves the markets. Is it banks, hedge funds, or massive traders? Let's dive into the world of institutional trading and see how it affects price action. According to Albrooks, every trade in the market has at least one institutional side. But what is an institution? We're talking about banks, hedge funds, high-frequency trading firms, pension funds, mutual funds, or even ultra-wealthy individual traders. Retail traders like us rarely move the market, unless we're managing billions. Institutions control most volume and shape daily price action. Okay, now we're going to look at the different players in the market, from banks to large individual traders, and check out some chart examples to see how they operate. Liquidity search by major banks such as JP Morgan and Goldman Sachs. These large candlesticks are often created by banks. Banks act as market makers, meaning they hold the majority of the market liquidity. When they enter or exit the market, they create a strong buying or selling pressure, which results in large candle or even a full daily trend. For example, in the Dow Jones, when you suddenly see a strong move start, it's often triggered by banks like JP Morgan or Goldman Sachs stepping in. Hedge fund big entry on earnings news. Hedge funds usually look for quick high profit opportunities. For example, when Nvidia reports very strong earnings, hedge funds enter with a huge positions and push the price up rapidly. This type of entry is usually sudden, and on the chart you will see a sharp spike or reversal. That's the main difference from banks. Banks tend to drive long trends, while hedge funds are after explosive short-term moves. HFD algorithm spikes. High-frequency trading firms use algorithms and extremely fast connections to trade. They place thousands of trades in fractions of a second. On 1-minute Tesla chart, you may notice small but very quick bursts of activity. These tiny movements might not make sense to us retail traders, but they are the result of HFD algorithms taking many small but consistent profit. Pension fund strategic positioning. Pension funds have a completely long-term perspective. Their goal is not to profit from a few days of movement, but to plan over years or even decades. When these funds enter the market, they usually invest in assets like gold, bonds, or large stock indices. Their entry can generate large sustained move because of the massive capital they manage. For example, when a pension fund starts accumulating gold, you will see a long-term uptrend forming on the chart. Mutual fund buying pressure. Mutual funds collect money from regular people and invest it into a diversified basket of assets. Unlike hedge funds, they don't take extreme risks. Instead, they focus on steady growth. When these funds receive large inflows of cash, they begin buying gradually but heavily. On S&P 500 ETF, for example, you can often see a steady rise driven by mutual funds activity. Big individual trader impact. Besides institutions, there are also large individual traders with massive capital. These are often billionaires or very skilled traders. When they place a huge order, it can create a strong candle on the chart. The difference from banks or hedge funds is that their moves are not consistent pattern, but sudden spikes. For example, in Tesla, you might see a big candle caused by the entry of a wealthy trader. Now we're going to talk about real-time impact in the market and look at some examples on the chart. Large institutions like banks and funds don't always want their big orders visible in the market. That's why they use dark pools to execute large trades without causing sharp volatility. By analyzing order flow, we can trace the footprint of these hidden orders. Here on Nvidia's chart, we can spot two massive dark pool block trades. One worth about $81 million at $140.42 and another around $29 million at $141.94. Right after these trades were executed, the price quickly started to rally, and later we even saw a pullback that retested this exact zone. This shows how large dark pool orders often leave a footprint that becomes a key support or resistance level for the market. Alright, now let's take a quick look at an example of HFD and latency arbitrage on the Dow Jones chart. As you know, HFD firms run ultra-fast algorithms designed to capture even millisecond price differences between exchanges. This speed advantage often creates sudden spikes on the chart, movements so quick that regular traders usually don't even notice them. Now, based on everything we've covered so far, it's time to take a look at the market heading into midsummer 2025 and explore which scenarios seem more likely given interest rates, inflation trends, and even the recent buzz around tariffs. In the summer of 2025, banks, funds, and major institutions pulled capital from high valuation tech stocks and moved to defensive sectors like utilities, healthcare, and consumer staples. Why? Tech valuation hit a PE of 33. GDP growth slowed from 2.5% to 1.4%, and the VIX fear index jumped from 12 to 20. Now, how to spot institutional footprints in price action. One of the clearest footprints of institutions on the chart is the shape of candles at key levels. When you see a large candle with high volume or long shadow near support or resistance, it can signal heavy institutional buying or selling. In this Dow Jones chart, we have a fake breakout above last month's resistance followed by a sharp drop, often a sign of institutional selling pressure. In the Nvidia chart, we saw a deep pullback to support, immediately followed by a bullish trigger bar that pushed the trend higher. Never ignore these moves, because they are often driven by the decision of large market players. This is just the beginning of my journey to share real market insights with you. Subscribe now, and let's build the knowledge and skills that can truly transform your trading.